What's up, everybody? Welcome back. Today we are going to talk about understanding credit scores. Your credit score is determined by 5 different factors. I'm going to go through all 5, and I will put all of the information below in the comments so that you have them when you're moving forward. Obviously, I don't expect you to memorize everything that I'm talking about. If you have any questions, you know you can always contact us. Leave us a message. So first is payment history, which comprises of about 35% of a factor of your credit score. It's the biggest portion, and if you're not making your payments on time or you don't have a long history of payments, the score, your credit score, will be a little bit lower. Now, when your parents were younger and they said, oh, you gotta get a credit card when you're 18, we know best for you, they were correct. Okay, the second biggest part, it comprises of about 30%, is the amount of money you owe. So you have a car loan, you have 2 credit cards, and you are currently in a home that has a small loan. Those are big factors on how much you have left to pay off. It's 30%. Remember that. Third factor, comprises about 15% of your credit, is your credit history. The fourth factor, and it comprises about 10%, is any new credit. So if you've opened up 4 new credit cards in the last 3 months, that is going to be a 10% factor on your credit score. Last but not least, comprising of about 10%, is credit types. A few examples: car loans, home loans, vehicle loans, student loans, things like that are great examples of credit types.
I don't know if people are aware of what a credit rescore means. Maybe we could touch a little bit on that and explain. Throughout the loan process, once the loan originator receives all the documents, bank statements, credit history, they're going to be able to run a scenario in a program which will determine what best options to take in regards to increasing your credit score, whether it's paying down a few credit cards, getting rid of an auto loan. Situations like that and specific examples will be given to you from your loan originator to help you increase that credit score. With having a higher credit score will give you a lower interest payment and in the end lead to a lower monthly payment overall for whatever home you're going to be purchasing.
Now, 4 different ways to improve your credit score and make it strong. The first one would be to pay your bills on time. Make sure that you're always paying your bills on the due date. A thing that I do is I set a reminder in my calendar 4 days before the bill is due. I'll have a reminder, let me know, and I'll usually pay it that day. Now, if money's tight, I understand, but at least you have the reminder to let you know. Next is to keep your balances low. You want to make sure you don't max out your credit cards. You want to make sure you utilize at or below 20%. Now, that if you only have 1 credit card and you're at a $10,000 limit, you want to make sure that you're at 30%. You're only utilizing 30%. Anything higher is going to give you a negative score. Now, if you have 2 credit cards and they're both $10,000 values, you now have a $20,000 value of credit. You have 30% across the 20. That's how you need to look at it.
To break it down in numbers, $10,000 credit limit, you don't want to have a higher balance than $3,000.
Think twice before closing any of your accounts. This is super important, especially if you opened an account when you were younger and now it's 10 years later. That account that you opened up 10 years ago has a heavy weight on your credit score because it has a payment history and a history of credit. So you want to make sure that the older the account, you just want to keep it open. You want to minimize your credit applications. You don't want to apply for anything you don't need. If you don't need a new credit card, don't open it. If you're getting married and you want to plan your honeymoon and you want to open up this fancy, awesome travel card, do it, but make sure that you don't do it while you're in the process of buying a home because it will negatively affect you. If you're on the cusp of the income to debt ratio, you don't want to start opening up, 5, 6 credit cards because you want all the bonuses and all the perks of these credit cards. They all have a negative effect on your credit. So if you don't need it, don't do it. Another big thing about that portion is if you're going to shop around for lenders, they're all going to run your credit. So if you get pre-approved by mortgage company A and you want to check B, C, D, they're all going to run your credit. So be careful if you're shopping around. The best thing to do, and what we suggest, is to go maybe check 2 to 3 companies if you really want to shop around. Anything more than that is overkill and will negatively affect your score.
And while shopping and while getting pre-approved, you do have a grace period of 30 days to where you can shop rates and it will not negatively impact your score. It's called a soft hit. It's maybe 1 point on your credit score, but lenders understand that you need to shop the rate to get the best deal possible, and they're not going to negatively impact you for doing so. So make sure you do your due diligence and research in a timely manner so that if you do want to shop the rates, your credit score isn't going to be negatively impacted by waiting, a couple months after the first pre-qualification.
And that's it for understanding credit scores. Thanks for joining us today. If you have any questions, leave us a comment. You can contact us anytime. All of our contact information is in the description below, and we'll see you next time.
Continue to learn with local.